Imagine December 1930. You're standing outside the Bank of United States in New York City. Not the central bank, not a government institution, just a commercial bank with an unfortunately official-sounding name. A rumor starts in the morning. By afternoon, there's a line. By evening, the bank runs out of currency on hand. It closes its doors. And now the rumor is confirmed. It doesn't matter that it still owns assets. What matters is that the doors are locked and your money is inside. The Bank of United States had over 400,000 depositors. Most of them were immigrants, working-class families, small business owners, people who kept their savings in one place because that's what you did. The bank had 60 branches across New York. It held $200 million in deposits. That's roughly $4 billion in today's money. And in the span of 2 days, it failed. Not because it was empty, not because its loans had all defaulted. It failed because depositors showed up faster than the bank could convert assets into cash. You see, banks don't keep all your money in a vault. They lend it out. That's how they make money. Your deposit becomes someone else's mortgage, someone else's business loan. The system works as long as everyone doesn't ask for their money back at the same time. The collapse of the Bank of United States wasn't the beginning. It was a signal. Because once one bank goes down, you start wondering about yours. By the middle of 1931, a bank in Tennessee closes, another in Illinois, then 3 in Pennsylvania. The newspapers print the names. Your own bank isn't on the list. Not yet. In October 1931, more than 500 banks suspended operations in a single month. Not because they were all broke, but because fear moves faster than solvency. But here's the problem. When you pull money out of the banking system, you shrink the money supply. Banks have less to lend. Businesses can't borrow. They lay off workers. Those workers spend less. Other businesses suffer. The cycle tightens. And all of it started because you and a few million other people made a perfectly rational individual decision. In Nevada, the governor declares a bank holiday. That's a polite term for shutting everything down. He orders every bank in the state to close for 12 days. The idea is to stop the panic, but it has the opposite effect. Because now you're thinking, if they had to close the banks, maybe things are worse than they're saying. Franklin Roosevelt took office on March 4, 1933. Within days, he declared a national bank holiday. Every bank in the country closed, not just the weak ones, all of them. The entire system paused. For 4 days, you couldn't deposit, couldn't withdraw, couldn't write a check. The economy froze. When banks reopened, they did so under new rules. And crucially, Roosevelt announced a new program. Deposit insurance. The government would guarantee your savings up to a certain amount. If the bank failed, you'd still get your money back. That changed everything. If your money was guaranteed, you could leave it in the bank, even if you heard a rumor. Fast forward to today. You check your phone and see a headline. Regional bank faces liquidity concerns. The difference now is the insurance. Your deposits are protected, but the system still relies on the assumption that you won't all show up at once. And if that assumption breaks, the bank can still fail, even if it was solvent yesterday. If you learned something new today, then do subscribe. And if you'd like to know when the next story is released, you can turn on notifications by clicking the bell icon. See you next time.